President Trump out yesterday tweeting that the bonehead Federal Reserve, Jay Powell, should be cutting interest rates to zero, maybe even going negative, doing QE and of course, doing the things that Europe is doing to try to stimulate economic growth. Now, the real question is, though, does that actually work, and is it a good idea? It sounds good on the surface because, quantitative easing and zero interest rates, work to boost the economy. Seemingly after the 2008 financial crisis, markets went up markedly, 300%, because of all the quantitative easing that was put in. But did it actually work to improve the overall economy? With us this morning is Michael Leibowitz, certified financial analyst, to talk about this a little bit more. So, Mike, what was your initial take on Trump's tweet yesterday?
It's scary because the United States, we've held ourselves out as having positive interest rates, as hopefully not going down that rabbit hole. And Trump is advocating exactly what is crushing Europe, what is crushing Japan, and what has just a detrimental effect. Yes, it may spur a little bit of economic growth, but Lance, we've showed a chart a million times showing GDP and interest rates both going down together, because the lower rates go, the more speculation the money is used for and the less real investment that it goes to. And it's a pretty simple equation, and it hurts long-term growth to benefit and to help political expediency and short-term growth.
Right. Well, and I think that's the real thing is that, politically and as we move into an election cycle, you may get a little bit of short-term pickup from doing this, but the long-term economic effects and the long-term issues of what happens, kind of underneath the surface, as has already been proven not to be good. Even here in the United States, it may appear that everything is doing great because the stock market's up near all-time highs. But as I was talking about a second ago, you've had a massive wealth transfer in this country. Because of that, the wealth is transferred to the upper end of the income class. So, hey, congratulations. If you had $1 million in the bank, you're doing awesome. You're also in the top 2% of the country. The bottom 80% is a far different picture. They haven't participated with the surging stock market. Their wealth hasn't grown exponentially, and their wages have certainly not grown in conjunction with a booming stock market, which you would have expected that would have happened, that corporations would have shared the wealth, right?
I mean, look, rates have come down in the United States a lot over the last 6 to 9 months, and economic growth has not jumped. It certainly helped the housing market a little. It's helped corporations refinance some debt and lower some interest expense. But look, the economy's been going down with interest rates dropping, regardless of what the Fed does. The real rates that matter, the 2-year, the 5-year, the 10-year corporate rates, mortgage rates have been dropping like a rock, and it hasn't really helped the economy. So what makes us think that if we keep lowering rates, it's going to help the economy? Whereas we also have history books from this country, from Europe, from Japan that show us quite the opposite.
What Trump is advocating for is, in his tweet in particular, was zero interest rates or even negative. We currently have right now about 30% of sovereign debt. That's debt issued by countries that are running negative interest rates. And what every one of those countries has in common is two things. One, they have a very, very slow rate of economic growth, if not borderline recessionary. And B, their banking system is in shambles. It has not helped create a stronger economic or financial system carrying negative rates. Why is that?
I think so. How do banks make money? They borrow money from depositors, or they issue debt, and then they lend the money out to someone else. So as rates go lower, people are less likely to deposit money in a bank. So if you go up to your local bank right now, and there are two banks right next to each other, one has a deposit rate of 1% and one has a negative 1%, you're going to go to the positive 1%. You're going to really think about the negative 1% bank. So what do? They have to increase their rate. Maybe they increase it to minus 0.5%, minus 0.25%. But the point is they don't have flexibility to lower rates on the borrowing side, and lenders want the low rates. So their margins get squeezed. And we're seeing this. Japan, they've been getting squeezed for well over a decade now, and it's really accounting tricks that have kept the Japanese banking system alive. European banks, we've talked about Deutsche Bank, all the German banks, UBS, other banks in Europe that are getting squeezed. And the bottom line is when there's a recession, these banks will take credit hits and losses, and they can't make it up on the profit side.
So the theory is, of course, and this is the short-term kind of idea that, boy, if we did this, we get a boost in the stock market. And that'd be great for Trump in the short term because, again, maybe we get a pop in the market because of, if the Fed came out in September and cut rates to zero right now, you get a pop in the markets, at least in the short term. But, long term, the effect is likely not going to be there because of, the reality is that economic growth is already slowing. We're already at the end of a cycle. And the risk that Trump runs at this point is getting a short-term benefit that actually winds up turning out to be a much longer-term nightmare for the markets and the economy, stripping the Fed from any tools that they'll have available to actually work against the next recession.
Right, right. I mean, ideally, what we would love to see from the Federal Reserve, from the president, from Congress, and this is for prior Congresses, prior presidents, is a fiscal and monetary policy that says, what can we do to boost economic growth in 2025, in 2030, in 2035, not for the next 10 minutes. Right. Because that's what we've done for the last 30 years. We've boosted short-term growth, and we get a sugar high, and then when you come off that sugar high, the natural growth rate of the economy is lower than it was before, and it's a hole. It's a hole we're digging, and we're pretty deep into that hole now with a huge debt burden at corporations, consumers, and the government. And the only way to help it is to keep playing the same game. It's a Ponzi scheme.
Well, yeah, it is. In a lot of ways, and we've written this before, is that this is the equivalent of trying to solve a short-term debt problem with more debt. So, just maybe if we just keep, going deeper into debt, it'll eventually kind of work itself out some way. And that obviously isn't happening. And, so this brings up the point that I want to talk about here in just a minute after the break is, this idea of refinancing all of our debt. So we do have, 22 trillion in debt. That's well on its way to 24 trillion by the end of next year. We're running $1 trillion deficit at this point, which means that virtually 95 cents of every dollar we bring in from tax revenue simply goes to cover interest on the debt, as well as Medicare, Medicaid, Social Security, prescription drug benefits, right? The mandatory spending. 95 cents of every tax dollar comes in, which doesn't leave anything else for defense spending or other functions with the economy, infrastructure spending, whatever it is. That's all got to come from debt. So if the idea now is, well, let's use zero interest rates, refinance the debt for as long as possible, do a 100-year term on the debt itself, and then we'll go from there.
Lance, speaking of which, the European Central Bank has just announced that they're going to cut rates by 0.1%. So now they're going to be minus 0.5%, and they're going to restart QE at 20 billion euros a month.
There you go. This is what Trump's advocating for, right? Cutting interest rates to zero or negative, doing QE, and this is going to help support economic growth. But it's not working. It's clearly not working in Europe. It's not working in Japan. And so why is it that we think it's going to work here? The other side of this question is that Trump's advocating to basically refinance all of our debt. The White House and the Treasury Department are considering issuing a very long-term bond, doing something like Australia did with a 100-year bond, which, by the way, worked out miserably for Australia when they did it. But what's the idea of financing here? If we take very low interest rates, we refinance all of our debt into a 50-year bond, say at 1%, right? Or 1.5%, whatever the number would be, 2%. What's the long-term ramifications of that for the economy?
Well, first of all, Lance, you can't do it, right? They're refinancing debt all the time. Every day there's debt that matures, and they replace it with new debt at lower costs. So that's already going on. But this whole idea of 50-year or 100-year debt at whatever the interest rate is ridiculous because the U.S. can't issue enough of it to really make a difference. That's not to say we can't issue 50-year or 100-year debt. We certainly can. But the idea of issuing even $500 billion of it is preposterous, and we're going to borrow another $1.3 trillion just this year alone. So, first of all, we have to remember they can't really do it with 50-year and 100-year debt. But the question is, what if we can just get all our debt to 0%? And you, at that point, will have destroyed any savers. That includes all the pension funds, the large group of baby boomers that are entering retirement and will not be able to save money in any meaningful way. And we will effectively be forcing all our investment returns to come on the heels of a stock market that, as we've talked about, is very overvalued. So from an investment standpoint, and not just investment, but retirement safety standpoint, that creates massive problems.